You've managed to save some money and now you want to start investing for your future. You've heard that putting money into the stock market can give you a higher return than putting it into a savings account. And you're 100% right. But where do you start? Do you buy individual stocks or an index fund? Do you manage your money yourself or pay a professional to do it? Well, in this video, I'm going to explain to you the different options, but more importantly, show you the data so that you can beat 96% of all professional fund managers over time and build a portfolio that guarantees future wealth. And don't worry, I'm not going to be selling you anything or asking you to invest in a £200 day trading course. This is not that type of channel. All I ask is that you enjoy this video, you hit the thumbs up and subscribe. So let's get into it. To get started, let us quickly set the context and define the difference between an individual stock and an index. A company's stock, also known as an equity, represents ownership of a fraction of that company. When you purchase that stock, you're purchasing the rights to a proportion of the company's assets and a share of their profits, which they pay out as dividends. Company stocks are listed, bought and sold on a stock exchange. An index, on the other hand, is basically a collection put together to create a basket of similar stocks. For example, the FTSE 100 index is a collection of the largest 100 companies listed on the London Stock Exchange by value. Rather than buying any individual stock, you can buy all the stocks within an index by buying an index fund. An index fund owns all of the stocks within a certain index and tracks the performance of that index. For example, Vanguard's VUKE index fund tracks the performance of the FTSE 100 by buying, in the same weighting, all of the individual shares of those 100 companies that make up the index. When the index goes up, the index fund goes up by the same amount. When the index goes down, the index fund goes down by the same amount. When getting started in investing, I, like many others, believed the way to make money from the stock market was to buy individual stocks that I believed were going to go up over time. It makes sense, right? We've all heard stories of a friend who's made a killing by investing in stocks like Apple and Amazon 20 years ago. And now they're sitting on the beach in Bali sipping on Mai Tais. And it is possible. If you'd invested $10,000 into Amazon stock when it first listed in May 1997, your $10,000, well, that'd be worth 12 million today. That's a mind-boggling 120,000% growth. Whereas if you'd invested $10,000 into the benchmark index, the S&P 500, your $10,000 would be worth $53,000 today. So whilst good, you'd probably be settling for Mai Tais in your back garden. So it seems obvious. Set up a brokerage account like Freetrade or Webull, which are both mobile apps. Invest in a high growth stock. Sit back, relax, and wait for your net worth to go through the roof. Right? Well, unfortunately, it's not that easy. Finding and investing in undervalued stocks that are going to beat the market over time is really hard. So hard, in fact, that even the professionals struggle to do it. Seriously, professional fund managers who are extremely intelligent, have studied for years, work full-time on picking stocks, and are paid extremely well to do so, fail to beat the market over and over again. If you look at the SPIVA scorecard, which measures what percentage of professional fund managers beat the market, you will find that in a 5-year period, over 80% of them had underperformed the return of the S&P 500 index, which is similar to the 5 years before that and the 5 years before that. You might be saying to yourself at this point, well, I'm smart enough to be in the 20% that did beat the market, especially if I take the time to read the company financials and believe in the product that the company is offering. But consider that the data shows that those 20% of professional fund managers that beat the market won't be the same 20% that beat the market in the next 5 years or the 5 years after that. Tony Robbins, the gravel-voiced guru, who has a similar voice to me, even popularised a study that showed over a 15-year period, only 4% of professional fund managers managed to beat the market. Now, I'm no Sherlock Holmes, but I see a pattern emerging. I'm not saying it's impossible, but if the full-time professionals are struggling, then I don't fancy the odds for average Joe investors like me and you. Another problem with picking individual stocks is that it probably means you're going to be far less diversified, i.e. you're going to be more concentrated and exposed to the fortunes and failures of the individual stocks that you've purchased. Yes, you might be one of the lucky ones that hits a home run, but a study in 2017 by Arizona State University showed that all stock market returns since 1926 can be attributed to only 4% of the best performers. You might be lucky enough to pick one of the 4% that makes up future returns, but more likely you're going to suffer catastrophic decline. How likely? Well, a 2014 study by JP Morgan showed that 40% of the stocks listed between 1980 and 2004 fell by 70% or more and never recovered to higher than a 60% loss from their peak price. To be clear, that means if instead of investing that $10,000 into Amazon stock, you invested into any one of the 1,200 stocks that suffered from the catastrophic decline, your $10,000, well, you'd have lost $7,000 of it. Gutted. It could be worse. Imagine you'd invested in Wirecard or Hertz, Enron or Lehman Brothers. You'd be lucky enough to be walking away with anything at all. Just remember, nobody can see the future. Nobody knows which stocks are going to go up and which stocks are going to go down. That's why the quote, "Stock market forecasters exist to make fortune tellers look good," is so appropriate. Ask yourself, are you really willing to put your hard-earned savings into individual stocks on a hunch and a hope for the best, which you may suffer a catastrophic decline? For me, and I'm guessing for you, that's not a risk I'm willing to take. So hopefully, by now, you can see that picking individual stocks might not be the best route to go down. So what should you do instead? As it's so hard to beat the market, why not try and simply match the market? Instead of picking individual stocks, buy the whole index in a low-cost index fund and keep investing into it as and when you can. How will we do? Well, remember, nobody can see the future. But if we look at historical data, it shows us that we can reasonably expect a return of between 8 and 10% per year on average, with dividends reinvested. When I say long term, I'm talking about 30 years plus. Just remember, every time you invest in the stock market, you should only be using money which you don't expect to need or want in the next 10 years at least. It's definitely not money that you're going to need in case of an emergency. The longer that you leave it in, the better. Not only will you be benefiting from the 8 to 10% average return per year, but you'll also be benefiting from what Albert Einstein calls the eighth wonder of the world, compound interest. Yes, I know this doesn't sound that exciting, but imagine this. You'd invested $10,000 into the S&P 500 index in June 1990, and then you added $1,000 every month thereafter for 30 years. You managed to ignore the fact that there was a dot-com bubble, financial crisis, and the coronavirus crisis, which crippled thousands of people and made them bankrupt. Well, that $10,000 investment would now be worth $1.71 million.
$1 million.
That's right. Despite there being multiple crises over that time period, you would have walked away with a very healthy retirement fund. Now call me boring Bob, but that's music to my ears. And the cherry on top is that you can achieve these results by doing very little. It's even encouraged that you do very little. The less that you watch and look at what the market is doing on any given day, the more successful you're likely to be. The phrase set and forget really comes into play here. It might sound a bit dull, but as investor George Soros said, if investing is entertaining, if you're having fun, you're probably not making money. Good investing is boring. He was ranked 29th richest person in the world in 2017, so I'm happy to take a leaf out of his book. My personal idol, Warren Buffett, who made $70 billion from investing and is the cult leader to financial nerds like me, preaches the same principles. Although a value investor himself, he recommends most people use index funds. He even went as far as saying, by periodically investing in an index fund, the know-nothing investor can actually outperform most investment professionals. He's so confident in the performance of index funds, he's instructed the executives of his will to invest 90% of his wealth into low-cost index funds on behalf of his wife when he passes away. What's that? My wife's expecting me to leave her $70 billion. No pressure. The least you can do is hit that like and subscribe button to help me out. So what do? By now, hopefully it should be obvious. I've shown that picking individual stocks is both irrational and makes no logical sense. But I am human, and I have all the same biases and overconfidence in my own ability as everyone else. Truth be told, I have invested in individual stocks in the past. To mitigate my losses though, I limit myself to individual stock purchases up to 5% of my overall total portfolio. For me, this is gambling money. And like gambling, it's money I'm willing to roll the dice on. Yes, Lady Luck might be in my corner and I win big and get really lucky after putting money on Spurs to win the Champions League. Or, in financial terms, I purchase Amazon stock before it becomes Amazon. But in all likelihood and reality, this is money that I'm likely to lose. It's just money put aside to make the game more interesting. And that's right, you guessed it. The rest of the 95% of my portfolio, they're in low-cost index funds, like Vanguard's VWRL. I'll go into more details about my exact portfolio in a later video. So, with all this in mind, if you're somebody who has all their investments into individual stocks, it might be time to start thinking about hedging your bets and diversifying your investments into index funds. Maybe you're one of the lucky ones who's experienced a home run. Or, unfortunately, like many, you've experienced firsthand what a catastrophic decline feels like. Let me know in the comments below what your experience has been. And if you're new to investing, let me know what you plan to do. And hopefully this video has helped you avoid some of the common mistakes that we all make when starting out in investing. So that being said, thank you so much for watching. If you haven't done so already, hit the like and subscribe button for more weekly content on personal finance and investing. And if you know someone that would enjoy this video, please share it with them. As always, I want to leave you with a quote. Investing should be more like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Las Vegas. Thank you so much for watching. Until next time.